Great. Thank you, Carrie, and welcome everyone. Good afternoon or good morning, depending on where you're joining us from. We are glad that you're here with us today. We're excited to share with you the state of the engineering economy, the Q3 results of the Engineering Business Sentiment Study. Thank you to all of you who have participated. We had record number participation this quarter, so we're very excited about that. You know, for those of you who have been watching for since the beginning of the year, Q1, we had some really strong results. We were excited to report. Q2 was a bit of a downturn as we were in the middle of the beginnings of all the tariffs, and Q3 we're excited to share with you. So I'm not going to do any spoiler alerts, Joe. I'll leave that for you. But we're excited to have Joe Bates with us, our senior research consultant from the ACEC Research Institute, as well as Thomas Grogan, who is the senior director for economics and market intelligence at ACEC. They've got a lot of great data and insights to share with you. And I'm going to turn it over to Joe to get started.
Thanks, Daphne. And Thomas, good to see you today.
Yes, great to be here.
We have a lot of great stuff to talk about. So we're going to jump right into it. We typically talk about three things. One is how is the U.S. economy doing? Then how is the current mood for our industry regarding our sentiment? And lastly will be future looking sentiment. And so we're going to hop right into the U.S. economy since there's plenty to talk about here. So the first thing we like to share is the latest readings on the US GDP. And you can see that in Q1 we had a negative reading, and in Q2 we had a very positive reading. But there's a lot of noise that's sort of baked into the GDP data, which can actually be a little bit difficult to discern. So one of the issues here is, of course, companies during the first quarter were trying to front run the tariffs that we all thought to be coming in April. So many organizations, many companies were ordering from abroad ahead of time, trying to build up as much inventory pre-tariffs as they could. And when imports are calculated as part of GDP, they're actually negative because you're sending that money outside of the US borders. Once those tariffs took place and imports dropped dramatically, then that actually had the opposite effect to make GDP look like it's much higher. So that's my layman's explanation. But Thomas, do you want to maybe explain that a little bit better since you're our an economist?
I mean, I think that is the right way to think about it. When GDP is calculated, there's essentially four variables: government spending, household spending, business spending, and then net exports, which is exports minus imports, in their parentheses. And so in Q1, imports being significantly higher than exports made it negative enough to, make all of GDP negative. With the newest quarter, exports were significantly higher than imports. Just looking at the data, that net export value on average since 2021 is about negative 0.1. So we do normally import more than we export by, that negative 0.1%, or about, I guess it's negative 10% impact on GDP. In Q1, that number was more negative 4.65, and then in Q2, that number was 4.95. So it's a real big pendulum right there, causing, as we could see visually on this chart, excluding exports, maybe that real GDP number could have been closer to about 1%, which is low, right, compared to historical numbers. So that is like, it's kind of separating out the variance from the overall trend, which I think, is maybe GDP growth. Real GDP growth is a little lower now than 3-4 years ago. But yeah, it makes it hard and challenging to kind of figure out what is actually going on when so many variables are changing so much so quickly by so many different amounts.
Yeah. So I think that's kind of the theme for today as well. There's a lot of change that's going on in the economy, and that's causing a lot of challenges in understanding some of these numbers. As you said, it's maybe real GDP is somewhere in the 1%-ish range. And if you looked at the consumer spending number that was part of GDP, it was sort of a 1.9 addition to GDP. So we're doing okay, but we're certainly not, I think, in as strong of a position as we were last year. And we see that with unemployment and job growth as well. Not so much unemployment, because we actually have seen the unemployment rate very range bound. So it's been anywhere between 4 and 4.2% for the last year, and even longer than that. But what we've noticed in this year is a marked slowdown in the number of jobs that are being created each month. So if we go back to 2023, we had on average 234,000 jobs being created on a monthly basis. That was pretty darn good. In 2024, we slowed down to 179,000 on average each month. And now this year, when you add in the revisions to May, June, and those new July numbers, and we're going to get August data tomorrow, so be on the lookout for that. We have 85,000 on average. So a huge slowdown in jobs. And there were big revisions to May and June when the July numbers were released. And I want to address that. This is not uncommon at all. In fact, every time there's a new monthly jobs report, they go back 2 months. I misquoted yesterday, Daphne, when I told you three, but they go back 2 months prior and they revise those numbers because they have more complete data. This is based on a business survey. And when they provide that monthly estimate, the first estimate, it's based on partial data. So when you have a lot of change going on in the economy, which we do right now, these numbers are much more suspect to revisions and revisions of larger magnitudes. And this has happened before in the past. It's not unusual, although it's not something that happens to this magnitude very often. So, nonetheless, we're seeing a job market that is much, much slower than what we saw in the prior 2 years. And I think that's where we're a little bit concerned and we're watching what's happening with the job market. Thomas, did you have anything else you wanted to add to that?
Yeah, no, I mean, I think it also is this situation we've talked about a little bit, or actually for a while on here too, is, we're hitting a minimum, like the unemployment rate is still very good, especially in historical standards. Job growth slowing kind of was going to have to happen, right? Because we were adding so many jobs coming out of, this time 5 years ago, it was, 9 million people, getting unemployed in like the spring, or number might have even been a bit higher. So I think, yeah, it's kind of like, have we bottomed out, or is the concern that things could get worse, right? Like, and the good thing, or a bright side, is there doesn't seem to be a massive uptick in layoffs, right? So it's folks aren't adding jobs, but we aren't seeing a climb in unemployment or layoffs and first time unemployment claims out of the ordinary. So I think it's all kind of we're still trotting along.
Yeah, and there's a couple other factors that are keeping that unemployment rate low because typically it was, oh, we needed 200,000 jobs per month to keep the unemployment stable. But why is that not happening? Well, there's a couple factors. One is the labor force participation rate, which I'm going to talk about in a moment. The other is that we actually are having a net exodus in migration. So we are not growing the population of the United States through migration at the moment. I saw a report 2 days ago that indicated just this year there was a out migration of 1.1 million workers so far this year. So not only is the labor market not growing, in fact, it's possible that it's shrinking, and we don't know for sure yet. So when we talk about the labor force participation rate, we're actually seeing that start to decline again. So this is of the people who are available for working, the percentage that are seeking to work. And when that percentage goes down, we actually take some pressure off the unemployment rate as well. So there's a few factors that are keeping that unemployment rate where it is. But I think to your point, Thomas, we're not seeing a lot of new hires, and we can see that anecdotally. We've heard that many firms are sort of putting some pauses, or they had put pauses on hiring. And I've heard that in other anecdotes from other industries. I've also heard that it's very, very difficult for new college graduates who are trying to find their first job. My son happens to be one of them, so he's still looking. So there's a lot of things that are happening in the economy right now that are just, we're trying to figure it out and sift through it all and what does it mean for us. Another aspect of this is consumer spending. And in fact, consumer spending is holding up. That's probably the bright spot so far. If we didn't have the consumer spending that we've had, we certainly would not be in as healthy a position as we are. And I know that consumer debt is at an all-time high, but a few months ago when I looked at it, the ratio of debt to income was actually at a fairly historical normal average. So it seems like the consumer may still have some legs here and some room to continue spending. Wages are also continuing to increase at a nice, healthy pace. So as long as we can see a healthy consumer and we're not seeing huge losses in jobs, I think we're probably going to be okay, but there's still a lot of questions around that. The other piece here that we're concerned about, of course, is inflation. So we just looked at jobs and the consumer, and we're maybe okay there, but on the inflation front, that's the other side of the coin, what's happening. Well, if you just look at the last few months from April to July, when those tariffs started to kick in, you would think, oh my goodness, we're increasing our inflation rate, and we are. We're down to 2.3%. We're up to 2.7% as of July. Next week we'll get August number. It's expected to increase again. But if you go back 2 years to June of 2023, you see that we were at 3%. So we're not at that 2% target that the Federal Reserve would like to see, but we've kind of been going up and down, up and down, up and down. So the question now is, are we just in that little bit of an upcycle? Is it going to come back down again? Or because of tariffs and other pressures, are we going to see it go back up? So this is really something that nobody seems to really know for sure right now. And that's what the Federal Reserve is grappling with at the moment. And when we have our first look at some of our sentiment data, this is an inflation concern, and we use what's called a net rating scale for those of you who are new to this. And with the net rating, what we do is we take the percentage of positive responses and we subtract from it the number of negative responses. So you could have a positive 100 if everybody was positive about something, or a negative 100 if everyone felt negative. In this case, you don't want a positive number because of the way the question is worded. So inflation concerns are elevated because the concern is positive. But it is down from Q2, and Q2, as some of you may recall, was not a good quarter in terms of our sentiment. So we are coming back down a little bit, but we're still not at the levels that we were in the first quarter of the year when we saw very, very positive feelings among industry leaders. So again, better, but maybe not 100% out of the woods quite yet.
And Joe,
Thomas, yeah.
just to tag on to that, I alluded to this a little bit, I think, in my intro, but Q1 was fielded around Inauguration Day, right? So there was a lot of, I think, positive pro-business feeling about the new administration coming in. Q2, as I mentioned briefly, was fielded as the tariffs were going into play, and so we saw, a big negative impact there, and now here we are with Q3. So just to give everyone some context of timing of events that were happening.
Right. And in Q3, our fielding was in August, and August was a relatively calm month, relatively speaking.
Everything's relative now.
Yeah. So, Thomas, tell us a little bit more about some of your inflation data and what you're seeing.
Well, to your point, even though inflation maybe was 2.7 to 3.1%, or the CPI change, still being above 2 and really being above like a 2.4%, it's just making things continue to get more expensive, right? And we see here, looking back, that kind of increase in the cost of everything in our economy really took off in 2021, and we have not really gotten that under control. So I think that is something that, it's something to continue to monitor. Also something to keep in mind as the Federal Reserve has to make decisions about balancing inflation and employment and the overall economic growth, and what that can mean going forward, especially if economic growth slows even more, but we don't have these costs under control. It can be kind of tricky in terms of what can happen on the monetary policy side. But things are basically 25%, more than 25% more expensive now than before COVID. And so then if we kind of look at the breakdown of the items that we buy, which are either goods or services, and services really account for like 60 to 70% of what we spend our money on, which is that gold line. That is just growing even faster than the rate of goods. Goods would be physical items and are more sensitive to interest rates. So it's kind of like your cost of capital, and that's where things like the tariffs would impact that gray line. So seeing this and seeing that from that previous chart, things are still going up, and that's even with keeping kind of the cost of goods has been just going sideways since essentially May 2022, which is a month or two after the Fed first started raising interest rates from like that zero bound. I think a large potential up in risk is what happens if that gray line starts going up as well, because we don't have the cost of services under control. That's going to make inflation much more painful. And then when we kind of look at this in our industry, that black line is the non-residential construction producer price index. We see in the most recent reading, and maybe over the past 1 or 2 months, it has started to tick up again. We see that reacted kind of like how we would expect goods to react when the interest rate rose in the spring of 2022, and basically stayed somewhat flat. We even had a little bit of disinflation in 2023 with respect to that piece of the cost. However, the AE services, which are essentially the cost of our firms doing business, or what for a project, our firm's cost is a piece of everything, has just continued to gone up. Basically since the start of 2023, the services piece has increased at like 5 times the rate that the overall non-residential construction PPI had been increasing. But as I mentioned, in this data, especially because these are just the goods related to construction, like aluminum, copper, lumber, things that were front and center with all the tariff talk in the spring, that ticking up or starting to tick up is definitely a cause for concern, and how that can impact overall project costs.
And Thomas, how much of a component of that the service inflation is due to wages going up?
It is a decent chunk. I don't know if it'd be 50%. I will say insurance costs across the board, but also, you're as an employer, I pay this overhead on all my employees, which is made up of, many different things. Some of it is the laptop I give them, or, access to the car or other equipment. But then there's also kind of just like insurance, and that has been for well over a decade increasing, and it's also, impacting insurance with respect to like land development and all of that. So I would, it's probably, the wages are important. I think the insurance piece might be having a bigger effect than the wages, but it's probably like, 40% of that cost is the increase in the wages, to be competitive and keep your employees.
Right. So when we have a tight labor market, which we still have,
Hmm.
we are seeing wages going up, and our annual survey of that shows that in our industry, it's anywhere between 8 and 9, 10% year over year for several, like 3, 4 years now. That's going to add on, and then that insurance component. So I think that helps to give a little bit of understanding as to why that's going in the direction it's going.
Hmm.
All right. Well, that's how the economy is doing. So, it seems to be okay at the moment. The consumer's healthy, but we're not sure if job growth is, really slowing tremendously and enough to warrant some action there. We're concerned about inflation still a little bit, but we're not really sure what's happening there. There's still a lot of unknowns, which we've been sort of talking about all year. But give us some hard numbers. How is the industry been faring, Thomas?
Yeah. So in the most recent, industry revenue, we dipped a little bit quarter over quarter, but we're still up about 7.5% in total nominal revenue in Q1 2025 compared to Q1 2024. I based on the construction data that we had seen, and even starting, we'll see in a few slides, but some of the overall construction basically started slowing down in around May of 2024. Kind of would make sense that our industry would start to see some of that softening in growth. So still solid, but the 12, 15, 20% year over year growth that was happening in 2022, 2023 probably seems not likely in the foreseeable future.
Hmm. That's very interesting. And that is the first quarterly decline that we've seen in several, well, 5 years, it looks like. Is that right?
Yeah.
Okay.
Hey, Joe, we did have a question. It came in after you had already moved off the wholesale price slide, but so Thomas, maybe this is for you. Looking at that slide, what would the construction cost of a $10 million project from January of 2022 be equivalent to in July 2025? I don't know if you need to see that chart to answer it, or you want
Yeah,
to.
I mean, if we maybe go back,
Right.
maybe in January 2022.
That one.
Let's see. So it's going from like around a 30 to 8. I mean, as I quickly do my math and my Excel thing, let's see. We got 180 over 130.
I was listening to a commentator on CNN the other day, and they
It's
said,
about 40% more expensive.
Wow.
yeah, I heard someone say on the news that they don't do math on the fly. So you did a great job there.
Well
Yeah.
done, Thomas.
Well, the problem though is if you don't spend some time doing it, you are not even remotely close to the right number. So
Yeah, but no, I think that's a really good illustration of the increase in the project cost. So
right, yeah.
Significant.
So revenues, the growth rate of revenues dipped, right? Revenues did not dip per se, but the rate of growth did dip in the first quarter. However, our industry is still continuing to hire folks. So, to your question also earlier, Joe, about what's increasing, or the questions around the AE services cost, we are continuing to hire folks because there is still work, we're doing. And, I would guess it's a good sign that we can continue to hire folks, right? Because we have work to keep them busy. And it even almost accelerated a little bit in the last month or two. In July of 2025, hiring or total employment increased about 2.7%, which is in line, I believe. Maybe the period pre-COVID was around like 2.5%. Then after that dip, we were, pushing like 3.54% for a while. And it seemed in 2024, what we could see is things started to slow down and it was more like 1.9%. We see that line flat for about the first half of 2024. And then basically from the fall of 2024 through now, hiring still is kind of, above what had been the pre-COVID trend and is closer to a 3% increase in employment. So it is different than that, first or second slide we were looking at, where as a whole, the economy is not necessarily adding a whole lot of jobs. Our industry is still continuing to add jobs month over month. And so then when we look at total construction spend, as I mentioned, it's year to date down about 2.5% year to date spend in 2025 compared to 2024. It's still over $2 trillion a month that is being spent on construction. So it is still a very big piece of our economy. We could see that kind of local peak at around May of 2024. Things have been trending down. The private side has been affected more since, in this little downturn that we're having compared to public spending. However, the private market in terms of absolute levels is still like 3 times the size of the public sector spending.
I think that's really interesting, Thomas, given that we have heard so much about how government spending is being cut or curtailed, or some projects aren't being funded, but you're seeing a really marked slowdown in the private sector.
Yeah, and I think there are some pockets, and maybe it's a more like a moving of the money around for where it maybe had been allocated to other things. There are some little maybe slowdowns in certain public markets, but yeah, on the whole, public spending in July was up about 3.4% year over year.
Interesting.
Yeah. And so the declines, are not limited to one specific sector. So residential and non-residential are struggling a bit. Residential struggling a lot more, especially since 2022, when it basically had overtaken non-residential in terms of total construction spend. But again, we see that black line, a peak. Then we had interest rates rise, which led to mortgages rising, which was a slowdown in the housing market. It had slowed down. It seemed like it was rebounding a bit throughout 2024, but kind of hit another peak and has been declining since then. And then the non-residential sector, some of it, I think certain sectors that are more interest rate sensitive, which we'll see, are definitely feeling this cost of capital being higher for longer. And then I think there's also just general, changes and trends in other sectors that were, really hot in 2022, 23 that are just not getting as much investment today compared to 2, 3 years ago.
And I think it's remarkable because I know we have a shortage of at least 1 million units in housing from what we, should be at. And that, just makes the cost of housing more expensive.
Yeah.
Yet people, so people are having difficulty affording new homes, but yet we're not building them because it still costs too much to build them.
Yeah, no, it is a tough puzzle to solve.
Right.
And so then when we look at specific sectors, for sectors that are doing good, I call out water for both water and then kind of the sewage and wastewater are still growing pretty robustly. And I think those, you even before this year began, if you had to kind of focus generally on sectors, water, it's not in the top 5, but I think energy, just with overall trends. So kind of again, figuring out like long-term trends for some of the short-term variability or noise. Those are going to, maybe be a bit more stable. Amusement and recreation has been doing pretty well. I think that is a sector though that will probably be more tied to the economy in the sense of, people wanting to spend money on these experiences and, things like the Sphere in Vegas or, these massive football stadiums or other sports arenas, how long, discretionary spending can support that. With what is negative, right? We used to do this chart maybe a year and a half ago, and even the bottom sectors were still positive. They were just growing at 3 or 4%. Whereas now we have sectors that are in decline with commercial and residential leading that. And those, as I mentioned, are really affected. Residential by the interest rates, commercial a bit by interest rates, a bit by other, general trends with respect to, the shifts in where people live and what's happened with, logistics and all of that over the past few years. And then, a sector like manufacturing, which had been booming 2021 through 2024, I think it's declining kind of as a function of how high money was being spent on it over the past few years. If we even look at, say, this top sector for public safety, right, which has grown and is, let's say, the fourth highest growth rate. I mean, manufacturing is still 10 times the size of that public safety market. So it's kind of like, yes, it is declining a bit, but it also is orders of magnitude larger, especially with manufacturing today than even 5-6 years ago. So I think there's a lot of uncertainty, and kind of what will happen over the rest of the year will maybe dictate, whether it's leveling off or declining more or not.
Yeah, I think this is really interesting data, and what struck me about what you said, Thomas, is that the bottom performers were positive, but now we are seeing some negative growth here in some areas.
Yeah.
So, well, let's turn to more of the sentiment data. And again, we're looking at Q3 data here, coming off of a pretty rough Q2. So what we saw overall is the U.S. economy had a much, much more favorable perception among industry leaders than in Q2. So we rebounded to a plus 50, and that is in fact the highest reading we've ever recorded on current U.S. economic sentiment. So people are feeling much better about the U.S. economy right now than they were last quarter, and they're feeling pretty much on par with where they were at the beginning of this year. Uh, Sentiment regarding the industry, which is in the middle, is improved over last quarter. Not quite back up to where it was, but still very, very strong. Remember, the best you can have here is a plus 100. So a plus 78 is very, very strong. And firm finances have also maintained their strength at a plus 83. So current sentiment is much better than it was, and it's looking very strong right now. When we look at sector sentiment, those red circles really should be orange. I think that was one of the changes that we didn't take. But it's not that they're negative, it's just that the sentiment regarding those sectors is less positive than the others. And the circles in blue are the most positive sectors. So what you see here is all these sectors, 16 of them that we've tracked for 4 years now. And you see the current quarter reading compared to each of the last 4 quarter readings. We show the change versus the previous quarter, as well as the change versus a year ago. So, not surprising, change versus last quarter. Almost all of these sectors have improved. And then the interesting thing to me is that versus a year ago, we still see most sectors are down a little bit in terms of sentiment. Still very positive sentiment. Of course, if you look at the bottom, government buildings, sentiment there is much, much less positive than it was simply because of the cuts that people are anticipating and some that have realized in the government spending area. But data centers is very high, and that has been one of our darlings for quite a while now. So the other areas that are doing well that sort of match with what you were talking about, water and wastewater is at a plus 78, but transportation is still perceived to be doing quite well. Very positive sentiment when it comes to airports, roads, and bridges. And then energy and utilities, that's very much tied to the data centers as well. So we have a lot of sectors that are, the sentiment is very positive. Um, Residential land development, not as positive. Commercial real estate, not as positive. So a few areas that aren't doing quite as well, but still positive overall. Backlog has rebounded. This is really good news. I was getting concerned over the last 2 quarters because we saw a steady decrease, and all of a sudden we jumped and back to 12 months as the median backlog. So that's really good news. In the full report, and we'll show you a QR code at the end of the presentation so you can download that full report. A lot of these numbers are broken down by firm size as well as region of the country if you're interested in looking at that detail. So smaller firms, those with 1 to 25 FTE, they tend to have shorter backlogs of about 6 months, whereas the largest firms have backlogs of 16 and 18 months or longer. But anyways, that median overall is back up to where we'd like to see it. And it tends to be in the 11 to 12 month range. So we're back in the sort of historical norm. When it comes to hiring, as Thomas said, we are still hiring. 9 out of 10 firms have open positions. I feel like I've been saying this for 4 years. I think it's because I have. We have consistently been understaffed and labor has been tight, and we have a median number of open positions of 5, and that's pretty much where we've been for a long time. Here's an example of me breaking it out by firm size. So you can see on average, smaller firms have 1 opening, whereas firms with more than 500 FTE have at least 100 openings. So you can see there the differences. When it comes to looking at those as a percentage of overall FTEs, that gives us a little bit better lens to look at. We have 8% overall, and we've been sort of historically now, since we started asking this question about 2 years ago, we've sort of been in that 9 to 8% range. Last quarter it was 7, so we did see in our data a little bit of a pause. Some firms, not all, but some firms did pause their hiring, but it looks like people are opening back up again, really trying to find the talent they need to get the work done. So very strong in terms of our labor. All right, so that's where we are right now. Things are looking much better than they were last quarter. Let's take a peek at what the future holds for us. When we look at forward-looking sentiment, this is perceptions of conditions 12 months from now. We certainly have rebounded from the lows we saw last quarter, but we're not really as positive forward-looking as we were at the beginning of the year. So we roughly have 3 camps of individuals here. We have about a third who are saying, I think the economy is going to be better a year from now. About a third say, I feel it's going to be worse. And the others are saying, I think it's going to be pretty much the same. So there's a lot of uncertainty and a lot of different viewpoints when it comes to forward-looking sentiment. And this is not just regarding the US economy, but the industry as well. And excuse me, when we look at your firm finances, that's also a lot lower than we have seen historically. So there's a little bit of concern among some firms that we're not going to be as strong a year from now as maybe we thought we would be, a few quarters ago. When we look at that sector level sentiment, here's where we really start to see some interesting changes. Again, we're off the lows that we saw last quarter. And so all sectors saw increases and almost all saw double-digit improvements over last quarter. Again, we see data centers being the most positive. We see energy and utilities being the second most positive when we look to the future. And we still see water, wastewater, roads and bridges, airports, all of those sectors that we saw noted earlier, and manufacturing facilities as well. Those are perceived to be doing better a year from now. But there are some areas that we think are not going to be doing as well, and in fact might be worse. Real estate, whether it's commercial or convention centers and sports facilities, as you mentioned, Thomas, maybe there's some getting to the limit of what we're able to finance in those areas. So there are some winners and losers here. And if you look again at year ago numbers, we're below where we were a year ago in most of these sectors. So this is where we're just okay, there's a little bit of cloudiness on the horizon. We're not sure what's happening and where we're going to be a year from now. And just to let you all know, that's not uncommon. We tend to not really be good predictors of the future, but it's more of a read of how are we feeling about the future. And typically, we've been very positive about the future, but we're feeling a little bit more hesitant in overall. Not everybody, but overall, some people are feeling more hesitant. We asked those who are pessimistic about the future 12 months from now, why? And we see political uncertainty, general economic uncertainty, inflation, and recession concerns are the top four areas. All of them have seen declines in the level of concern since last quarter, but they're still the top concerns. Tariff impacts, that has also eased a little bit, but it maintains its spot among the top five. Workforce shortage, that number's coming back up a little bit now. So again, that goes with this idea that maybe we saw a little bit of a pause in some firms last quarter, and now people are feeling a little bit better, so they're ready to hire and continue hiring. A few other areas that didn't make the top six, but some concerns. We see that the slow rollout of the IIJA is still one of the areas of concern, and it seems to be growing as an area of concern. Perhaps some of that is because of concern about the funds being dispersed or being available, and perhaps some of it is due to staff resources on the public client side. Perhaps there are not as many staff there now as there were, and so there's some increasing levels of concern in that area. When we look at future backlog, again, we're off of our low from Q2 of this year. However, that plus 21, which is positive, of course, is still our second lowest reading on record. So future backlog sentiment historically has been quite positive in that 30 to 40 range. And now we're still depressed, not negative overall, but it's still not as positive as we have seen. So again, a little bit of hesitation. And we see the same thing with hiring. Future hiring sentiment increased 7 points. So that's good news, but it's well below where it was a year ago. And this also is its second lowest reading on record. Not necessarily a bad thing if we slow hiring this a little bit because we are constrained on the labor force right now. But nonetheless, it still indicates some hesitation about what's happening in the future. Recession concerns have fallen back to our historical norm. It's at 41% overall. That's down 13 points from last quarter. So that's really good news. And as you can see, again, it's very much around its historical average now in the low 40% area. And we've asked this question for about 2 years as well. So again, I guess overall, we're feeling better about our current situation, maybe a little bit of concern among certain areas of the industry looking forward. And we have a couple questions we typically ask, some new questions that we have not ever asked before, or that we only ask maybe once a year. But Daphne, I see we have a question there.
Yeah, I was just getting ready to stop you before you went a little bit further.
Okay.
So when you're talking about record numbers, Joe, what's that span as it relates to the sentiment study? I think is the question. How long is on record?
Good question. So we've been conducting this study for 4 years now. We started in the fourth quarter of 2021. So when I say on record, we're talking about the last 4 years during which we've been conducting this sentiment survey.
Thanks, Joe.
All right, thanks for the question. All right, we will have time to take some other questions here, but I'm going to talk about a couple hot topics that we asked about. And it's really interesting because these are the reasons why we had such a wonderful response rate. Basically, we had an increase in the response rate of about 33%. So we had a lot of interest in these particular hot topic questions. And this is all regarding potential changes in the DBE program, which is the Disadvantaged Business Enterprise. This is a US DOT program, although it's actually implemented by each state. And so there's a court challenge going through the courts right now, which may impact this program. And we wanted to ask firms how they feel about it. Now, keep in mind that this is an individual survey. This is not one response per firm. We could have multiple people from a firm that respond because this is industry leaders giving us their thoughts on where our industry is going. So keep that in mind when you look at these sort of firm specific questions. There may be more than one individual responding from a firm regarding these questions. Nonetheless, 24% of respondents' firms have a DBE certification. Typically, these are small businesses because that's part of the definition that is required to be a DBE. We asked these DBE firms a couple questions. One is, do you agree or disagree with the statements? The elimination or alteration of the DBE program would negatively impact our firm's ability to pursue and secure public sector contracts. 9 out of 10 DBE firm respondents said, yes, I agree with that statement that it would negatively impact our firm's ability to pursue and secure public sector contracts. So this is a pretty big issue for DBE firms, most of whom are in fact small firms. Also, the DBE program is important to the success of our firm's participation in federally funded transportation infrastructure projects. Again, 85% agreed with that statement. So very, very strong support regarding the DBE program from those firms who are designated as DBEs. On the flip side, we asked non-DBE firms, who tended to be larger, of course, what they felt about potential changes. And here, it's kind of a little bit of a different story. We had a question stating that elimination or alteration of the DBE program would improve our firm's ability to pursue and secure public sector contracts. And we see about 6 in 10 actually said they agree with that. We also asked the question, the elimination or alteration of the program would increase our firm's interest in teaming with other firms or subcontracting or partnerships. And there it was pretty much split response. You had about a third who said, I agree, and 26% said, no, we would not be more interested. So there's really two sides of that coin. The DBE firms, the smaller firms, are much, much more likely to be supportive of that program. The larger firms tend to be a little bit less supportive of the program. So some interesting data for us to look at and think about as we move forward on the public policy side of things. All right, so we actually have a few minutes left for questions. Daphne, do you have any for us?
I don't see any in the chat. If you'd like to go ahead to the next slide, Joe, if anyone's interested in reaching out with some questions directly to Joe or Thomas, I do want to take just a minute and thank you both for sharing your data, for sharing your insights. Always interesting and thoughtful, and so we certainly appreciate that. Thank you to all of you who have joined us and those who participated in the survey. I just wanted to point out one thing. Joe mentioned there was about a 30% increase in participation, which is fantastic, and we hope that continues. But I also wanted to point out that it did not change the response as far as statistically across firm sizes, across geographies. Those remained very consistent quarter over quarter. So while we had the increase, it didn't, kind of throw off any of our comparisons, which was fantastic. So a big thank you to our donors who make this research possible. We could not do it without you. I know many of you are represented on this call today. Thank you for your participation. We have a number of new donors who have joined us recently, and a big shout out to them for joining as well. Next month, we have the fall conference of ACEC in San Diego, and we will be unveiling our 2025 economic assessment and 5-year forecast. So we hope you'll be joining for that. We also will be unveiling a big workforce study that we are in the middle of, and we'll hope you are with us to hear about that. Here is the QR code to download the full survey, which is available, or I'm sorry, the full report for the Q3 sentiment, which is available now. And we will also be sending you a quick evaluation of this session. If you could let us know what you thought about it, it helps us do a better job each time, we hope. So I'm just looking quickly. Oh, we got anything here in the chat? A recording will be available. Yes, it'll be available on our website tomorrow. And then you can get the full report here. In the full report, there's a lot more detail than we had time to cover today. So I hope you'll download that and have a look. And with that, Joe, Tom, and Thomas, thank you so much. We'll give everyone 9 minutes of their life back and hope everyone has a safe and wonderful day. Take care.
Great, thank you.